All right, let's jump straight into this explainer because the data we're looking at today from May 15th, 2026 reads like an absolute alarm bell for the gold market. If you've been tracking gold's incredible run lately, what you're about to see is absolutely critical. We're looking at a market that's fundamentally fracturing under the weight of a speculative extreme. And surviving what comes next, well, that requires knowing exactly what the data is screaming at us. Just listen to this stark opening warning straight from our source data. It states, gold is in the final manic stage of a speculative blow-off. A sharp, violent correction is not a possibility, it is structurally inevitable. I really want you to absorb that phrase for a second. Structurally inevitable. The market dynamics have shifted from a healthy bull run into this dangerous frenzy. But as you'll see, the opportunity that follows this inevitable flush is going to be truly historic. So here is how we're going to break this all down today. First, we'll go inside the historic COT mania. Second, how the macro squeeze sinks gold. Third, price levels of the flush. Fourth, the three-phase market roadmap. And finally, the actionable mandate. Okay, part one, inside the historic COT mania. The absolutely crucial point here is understanding exactly how stretched the market rubber band has gotten over the last month. We need to look under the hood at who is buying, who is selling, and just how extreme their positions actually are. This table brilliantly illustrates the mania. It tracks what our source calls the confrontation gap. Back in late April, we saw a pretty healthy narrowing of the gap between managed money, the hedge funds, and swap dealers, the big banks. But look at May 12th. That gap absolutely exploded by over 23,000 contracts in just 2 weeks, hitting a crisis level of 288,071 contracts. It's a completely unstable equilibrium. One side of this trade is going to break, and it is going to break violently.
And we aren't just pulling these numbers out of thin air. Here is the actual raw commitments of traders data from May 12th, completely authenticating this historic extreme. If you look closely, you can see that all three major speculative groups, hedge funds, institutional smart money, and retail traders, are now all aligned on the long side simultaneously. Think about that. There are almost no natural buyers left on the sidelines. Everyone is already in the pool, and they're all swimming in the exact same direction.
Now check out this staggering number, negative 190,056. The swap dealers are holding a record net short position of over 190,000 contracts. To really put that into perspective, that is 14.7% beyond the extreme we saw right before the brutal 2020 crash, where gold corrected by $400. The banks have a massive, massive financial incentive right now to press prices lower just to trigger long liquidation and margin calls. Moving to part two, the macro squeeze sinks gold. Let's zoom out to the macro picture and see how this builds a perfect storm against gold's traditional safe haven status. Because honestly, the external environment just turned highly toxic for the yellow metal in the short term. You might look at the news, specifically the geopolitical tension and the resulting 40% spike in oil prices and think, hey, that's got to be incredibly bullish for gold, right? But the source analysis shows it's actually a trap. That massive energy shock is driving up inflation fears, which is totally forcing the Federal Reserve's hand. Suddenly, the probability of a Fed rate hike has shot up to nearly 45%. This creates a lethal squeeze, a US dollar rising above 99, combined with soaring treasury yields. That combination absolutely crushes a non-yielding asset like gold, completely overwhelming its safe haven appeal. Add in the fact that India, a major buyer, just hiked import duties and crushed their physical demand, and you've basically got a macroeconomic anvil dropping on prices. Part 3, price levels of the flush. So the speculative dam finally cracked on May 15th. Let's look at the actual damage of that initial break and figure out where this falling knife is headed next. A single session experiencing a $13.3 drop from peak to trough? Yeah, that is not normal market behavior. The market plunged from over $4,665 down to around $4,531 in just a matter of hours. Make no mistake, this isn't some routine pullback. This is the definitive start of oppressive forced liquidation. If you're actively tracking the market, you might want to screenshot these targets right now. The technical breakdown is severe. We're looking at immediate support sitting at $4,510. Now, if that floor gives way, the selling is going to rapidly accelerate. The real structural bottom, that institutional demand zone we're looking for to finally end this pain, is significantly lower, somewhere down between $4,351 and $4,200. Which brings us to part 4, the three-phase market roadmap. Okay, now that we fully understand the immediate danger and that heavy downside risk, let's pivot to empowerment. We are going to lay out the exact three-phase plan to navigate this scenario safely.
The roadmap outlined by the data is crystal clear, but it requires serious discipline. First, we have to endure phase 1 to 3 weeks of violent liquidation. Prices will drop sharply as the weak hands get forced out. Following that is phase 2, a messy, volatile 4 to 8 week bottoming process. You're going to see sharp relief rallies followed by renewed selling. It'll be painful and bipolar. But all of this serves a purpose. It cleans out the market, ultimately setting up phase 3, an explosively upward, generational buying opportunity once the flush is complete. So, how do we actually know when phase 3 is finally here? Well, the opportunity of a generation arrives only when these specific COT conditions are met. You need to wait for managed money net longs to collapse back below 70,000 contracts. You need to see the swap dealer short position drop below 165,000 as banks cover. And, crucially, you need retail traders to capitulate and drop under 25,000 contracts. Until you see these exact metrics hit in the weekly reports, the trap is still active. Part 5, the generational buying opportunity. To really understand why phase 3 is so incredibly bullish and why you want to be ready for it, we have to look past the short-term panic. We need to examine the structural bedrock of the market, which remains incredibly intact, even as short-term speculators get completely wiped out. Central banks are quietly providing an absolute, unbreakable floor underneath this market. In the first quarter of 2026 alone, central banks hoovered up 244 metric tons of gold. Look at this. Aggressive buying led by Poland adding 31 tons on its way to a massive 700-ton target, and Uzbekistan taking 25 tons. This isn't just a tactical trade for them. It's a permanent structural shift toward de-dollarization. Once the speculative froth is totally cleared out, this massive institutional demand is going to drive prices to new all-time highs. Finally, Part 6, Actionable Mandate. Let's wrap this explainer up with some very clear, actionable rules drawn straight from our source analysis. Because knowing the data is only half the battle. Knowing what to do with it is how you actually survive. First up, the strict do-nots. Do not buy gold or futures right now. This is literally the most dangerous entry point we've seen in years. Do not try to catch this falling knife, and whatever you do, do not listen to the chorus of buy the dip calls you're probably seeing online. A dip implies a healthy, normal pullback in an ongoing trend, whereas what we're looking at is a structural flush. Instead, here is what the data is practically begging you to do. Stay in cash or short-duration treasuries to preserve your capital. Let the market do its worst while you are safely on the sidelines. Watch those weekly COT trigger levels we discussed. Managed money below 70K, retail under 25K. Let the data tell you when the coast is clear, and above all, exercise extreme patience. Patience right now isn't just a virtue, it is literally your strongest shield against a violently correcting market. So the final question I want to leave you with today is this. Are you going to let impatience get you caught in the manic, inevitable flush, or will you wait safely on the sidelines for the trade of a decade? Keep your eyes on the data, stay disciplined, and thanks for joining me for this explainer.